Welcome to the debate. Today, we're taking a microscopic look at a highly polarizing name in the AI infrastructure space, and we're really framing this specifically for new retail investors. We're looking at Nebius Group, trading under the ticker NBIS, so we're evaluating a vertically integrated GPU cloud provider, what the industry is calling a neocloud. And right now, it is navigating a pretty extreme high-risk, high-reward profile.
Yeah, and the central question before us today is very clear. Is Nebius Group a deeply undervalued hyper-growth AI play that retail investors should really start accumulating immediately? Or is it a dangerous capital trap, defined by unsustainable spending and massive customer concentration?
Right, and this debate emerges directly from their latest financial statements, recent industry reports, and the broader valuation assessments we're seeing in the AI infrastructure market. I'll be arguing exclusively from a bullish perspective today, so I'll focus on the company's severe undervaluation relative to its pre-sales and its exploding future annual recurring revenue, or ARR.
And I will be arguing exclusively from a bearish perspective. I want to focus on their massive looming capital expenditures, the ongoing net losses, and honestly, the extreme customer concentration risk that could completely wipe out those rosy projections.
Okay, let's jump right in. Nebius Group represents what I see as a generational buying opportunity for retail investors, precisely because of its severe undervaluation relative to its hyper-growth trajectory. When we actually look at the fundamentals, the growth rate is, well, it's almost unprecedented. We are looking at a Q4 2025 annual recurring revenue of $1.2 billion. That is an 830% year-over-year increase.
Right, and 830% sounds incredible on paper, but we have to look at what that revenue actually costs to generate.
Sure, but we aren't talking about abstract, hopeful software projections here. We're talking about hard, contracted infrastructure revenue. Looking ahead to 2026, conservative estimates place their revenue between $3 and $4 billion. And the absolute crown jewel of this bullish thesis is the $17.4 billion long-term contract with Microsoft. This is guaranteed future ARR. It completely secures the company's trajectory and it validates their business model. It also proves they have early access to NVIDIA's highly coveted Blackwell and GB200 GPUs. They've successfully positioned themselves as an indispensable partner in this massive AI training and inference workload explosion.
I come at it from a different way. The current financial realities make Nebius Group incredibly hazardous for retail investors. The fundamental flaw in that bullish narrative is the assumption that contracted revenue just easily translates into positive cash flow without, catastrophic friction along the way. Nebius has stated a goal of reaching 1 gigawatt of data center capacity by 2026.
Which is exactly what they need to service that massive Microsoft backlog.
Yes, but for the new retail investors listening, we really need to contextualize what 1 gigawatt actually means. 1 gigawatt is roughly the amount of energy needed to power about 750,000 homes. Building infrastructure at that scale isn't just buying computer chips. It's buying massive real estate, industrial liquid cooling systems, and securing entire local power grids. To achieve that 1 gigawatt goal, they are projecting a massive capital expenditure requirement of $16 to $20 billion.
Well, that is the cost of doing business in heavy iron infrastructure.
But that figure far outstrips their current operational cash generation. We cannot ignore the deeply concerning Q4 net loss of $173 million alongside a negative free cash flow of $562 million. They are burning cash at a breathtaking rate to build this out. Furthermore, you mentioned the Microsoft contract as a strength, but from a risk management perspective, it represents extreme customer concentration. For a retail investor, putting capital into a company that must spend $20 billion it doesn't currently generate, while tethered primarily to one client's ecosystem is, well, it's less of an investment and more of a venture capital gamble on perfect execution.
I see why you think that, but let me give you a different perspective. In the infrastructure business, contracted pre-sales of this magnitude entirely de-risk that capital expenditure. You build the capacity because the demand is legally binding and it's already sitting on your books. But let's look at how the market is actually valuing this execution, because this is where the opportunity for the retail investor lies. CoreWeave, which is arguably Nebius' biggest competitor in the neocloud space, reported their earnings today.
Right, and CoreWeave's numbers were highly instructive for this exact sector.
Exactly. CoreWeave is currently trading at a massive 28x forward enterprise value to sales multiple. For those newer to the space, the EV to sales multiple is basically a price tag the market puts on every dollar of a company's projected sales. If the market trusts your growth, they pay a premium. CoreWeave gets 28 times its sales. By contrast, Nebius Group currently trades at a mere 6x forward EV to sales multiple based on their 2026 projections.
Because the market is pricing Nebius based on its execution risk.
With 6x multiple means the market is pricing Nebius as if it has already failed to scale. Nebius has a target ARR of $7 to $9 billion. That 6x forward multiple makes the stock vastly undervalued. Nebius offers the exact same vertically integrated GPU as a service model as CoreWeave. They don't do web hosting or email. They just rent out massive clusters of AI computing power. Just like CoreWeave, they have the same NVIDIA partnerships and uniquely strong positioning in Europe and non-US markets. Yet a retail investor today can buy Nebius at a fraction of the multiple that private and public markets are assigning to its direct peers.
I'm sorry, but I just don't buy that. Let me tell you why. CoreWave's premium is justified by demonstrably better execution, actual scale, and superior risk management over a much longer timeline. They have proven they can plug these GPUs in without the data centers catching fire or running out of grid power. You cannot compare a 6x forward multiple based on a projected $3 to $4 billion in 2026 revenue to a competitor that is already actively operating at scale without the same degree of looming capital shock.
You don't think a 75% discount in the multiple is a severe overreaction?
Not at all. NVIDIA's lower multiple is not an inefficiency in the market. It is a highly accurate reflection of extreme execution risk. The market knows that getting from their current capacity to a 1 gigawatt operation requires a flawless rollout of physical infrastructure. If there are supply chain hiccups or if local power constraints delay their facilities, they will bleed cash. And here's the real threat to the retail investor. If they need to raise funds to cover those accelerating losses, we are looking at massive shareholder dilution. That could lead to potential multiple compression of up to 25%. A 6x forward multiple can very easily become a 4x multiple if the 2026 revenue gets pushed to 2027. You are entirely pricing in perfection.
That's an interesting point, though I would frame it differently. The execution risk is materially mitigated by the very nature of their partnerships. Let's look closely at that $17.4 billion Microsoft contract again. You framed this as customer concentration risk, but I argue this pre-sale contract is the ultimate bullish signal.
A signal is great, but it doesn't pay for concrete and copper wiring.
But it does ensure recurring revenue, and it provides absolute validation of Nebius' vertical integration strategy. Microsoft is one of the most sophisticated technology companies on the planet. They don't commit $17.4 billion to a neocloud provider unless they have thoroughly audited their supply chain and are utterly confident in Nebius' early supply access to NVIDIA Blackwell and GP200 GPUs.
Oh, I don't doubt they have access to the GPUs. I doubt their ability to finance the buildings to house them.
But the contract is already generating massive liquidity to do exactly that. Look at their Q4 operating cash flow. It was a positive $834 million. That isn't some accounting trick, that is real liquidity driven by advance payments from these exact agreements. They are literally being funded by their customers to build the infrastructure. It's like taking a massive deposit before you build a house.
And that's a compelling argument. But have you considered the structural nature of that operating cash flow? That $834 million in Q4 operating cash flow is purely an advance payment. It is effectively unearned revenue sitting as a liability on the balance sheet.
Yeah, but it's cash in the bank today.
Yes, but it's not sustainable operating margin generated from efficient, steady-state operations. It's a zero-interest loan from a customer, sure, but it is a one-time cash infusion that masks the underlying unprofitability of the ongoing business, which is glaringly evidenced by that $173 million net loss in the exact same quarter. But let's talk about the true danger of the Microsoft relationship. What happens if Microsoft or any of the hyperscalers successfully pivot to their own custom silicon.
You mean chips like Trainium or Maya?
Exactly. We know that the massive tech giants, the hyperscalers, hate paying NVIDIA's premium margins. They are aggressively developing their own internal chips to reduce reliance on NVIDIA ecosystems. If Microsoft's strategy shifts to utilizing their own internal silicon for the bulk of their inference workloads, Nebius faces an existential threat. Our risk scenario mapping indicates that a successful hyperscaler chip deployment could cause Nebius to miss their ARR targets by 30%. When your entire growth thesis relies on one mega company renting your GPUs, and that company is actively incentivized to build alternative solutions, you are standing on a trapdoor.
I'm not convinced by that line of reasoning because it mischaracterizes the current state of the AI infrastructure market. The demand for AI training and inference workloads, the actual heavy lifting of running these AI models, is growing at a compound annual growth rate of over 50%. The market for GPU cloud services will be in the tens of billions by 2026.
But the hyperscalers want to capture that value themselves.
They do, but they simply can't build data centers fast enough to meet their own demand. Nor can they produce internal silicon that matches NVIDIA's Blackwell performance for generalized workloads right now. The pie is growing so rapidly that there is more than enough room for neoclouds like Nebius to thrive alongside internal hyperscaler efforts. Microsoft needs Nebius because Microsoft doesn't have enough power to run everything themselves.
That might be true today, but investing is about looking 12 to 24 months out.
And looking out, Nebius currently boasts a fortress balance sheet to survive any potential shifts. They are sitting on $3.7 billion in cash. They have a negative net debt of $2.41 billion. And incredibly, they have only $36 million in total debt liabilities against total assets of $3.55 billion. Just to synthesize that for the retail listener, they have more cash on hand than the total value of their assets, and they essentially don't use traditional bank debt. They are perfectly capitalized to weather this build-out phase.
I have to stop you there. $36 million in traditional debt is great, but it doesn't solve the core problem.
Which is what?
The $16 to $20 billion CapEx mountain. While $3.7 billion in cash sounds like a fortress balance sheet in isolation, it is a drop in the bucket compared to the looming reality of their capital requirements. They explicitly need $16 to $20 billion to reach that 1 gigawatt goal by 2026. You cannot bridge a $16 billion CapEx gap with $3.7 billion in cash and advanced payments. It mathematically guarantees continued massive losses in the short to medium term.
They'll finance the later builds with the cash flow from the early builds. Their unit economics are already demonstrating a massive turnaround. In Q2, their gross margins improved to an impressive 71.4%.
Gross margin on a small revenue base doesn't equal net profit at scale.
What a gross margin of 71.4% means that for every dollar they make renting out a server, it only costs them roughly 28 cents to keep it running. Once a GPU is plugged in and rented, it is a cash-printing machine. And they achieved a positive adjusted EBITDA of $15 million in Q4, representing a 24% core margin. The narrative that they are just bleeding cash without a path to profitability ignores these massive margin improvements at the operational level.
Achieving 71.4% gross margins on a few early clusters is completely different from maintaining those margins while scaling a massive 1 gigawatt infrastructure footprint globally. The only way they fund that $16 billion difference is through taking on massive debt, which destroys the pristine balance sheet you just highlighted, or through equity issuance.
Which is standard for a hyper-growth tech company.
But look at the macro environment. If we see a macroeconomic slowdown in AI investment, which is a highly probable cyclical risk, and their stock price takes a hit, raising that capital will require staggering shareholder dilution. We're talking potentially up to 40% dilution. Retail investors jumping in now to accumulate this stock are essentially offering themselves up as the liquidity providers for a $20 billion construction project that carries immense execution risk.
But that perspective assumes the absolute worst-case scenario for macro AI spending. If we maintain even a conservative view of the AI model expansion, the revenue from the early data centers will comfortably finance the latter ones. The positive operating cash flow generation from advanced payments is a revolving door. As they bring capacity online, they secure more advanced payments for the next phase of expansion.
You're assuming demand stays at a fever pitch indefinitely.
The hyperscalers are telling us it will. in the high beta of this stock, meaning its tendency to swing aggressively with the broader AI sector, is exactly what retail investors looking for explosive growth should be targeting. If they execute on their 2026 revenue guidance of $3 to $4 billion, the current EV to sales multiple of 6x will aggressively re-rate to match their hyperscaler and neocloud peers, trading at 10 to 20x, or even CoreWeave's 28x.
Re-rating only happens when the market implicitly trusts the execution. And right now, the 6x multiple reflects a profound lack of trust. The market is looking at that negative free cash flow of $562 million and realizing that this is not a software company where incremental margins drop cleanly to the bottom line. Every new dollar of revenue requires a massive upfront capital expenditure in NVIDIA hardware, cooling systems, and real estate.
Which acts as a massive moat against new competitors.
It's a moat, but it's also a massive anchor. If the AI training demand softens, or if we enter a period of GPU oversupply, perhaps driven by the very competitors and hyperscalers we discussed, pivoting to internal chips, Nebius will be left with billions of dollars of depreciating hardware and a massive hole in their balance sheet. The downside risk here isn't just a slight miss on earnings. It is potentially catastrophic for the share price.
Let's summarize our positions on the core question we set out to answer. Should new retail investors start accumulating Nebius Group right now? I believe the evidence overwhelmingly supports taking a position today. We are looking at a company with a target ARR of $7 to $9 billion, operating in a market growing at 50% annually, backed by a $17.4 billion guaranteed contract with Microsoft. The current valuation at a 6x forward multiple is a stark anomaly when you look at peer valuations like CoreWeave at 28x.
It's an anomaly that exists for a very good reason.
It exists because the market is overly focused on short-term build-out costs. Yes, it's a high-risk, high-reward profile, but the balance sheet featuring $3.7 billion in cash and virtually zero traditional debt provides an excellent margin of safety during this aggressive scale-up. For new retail investors, allocating a small 5 to 10% portfolio position to NBIS is a calculated risk that is absolutely worth taking right now. The consensus target price is sitting between $143 and $152, which represents an immediate 60% upside from the current price of around $89. If execution succeeds over the next 24 months, this stock has the fundamental potential to deliver 2 to 3x returns.
My conclusion remains that accumulation at these levels is highly premature for a new retail investor. While I fully acknowledge the explosive ARR growth, the mechanical physics of infrastructure scaling simply cannot be ignored. The combination of a looming $16 to $20 billion CapEx requirement, deeply negative free cash flow, and a highly dangerous reliance on a single mega client makes the stock excessively vulnerable.
Even with the margin turnaround.
Even with it. Because if we see any macroeconomic slowdown in AI infrastructure spending, or if there are delays in their 1 gigawatt rollout due to power grid issues, Nebius will be forced into massive dilution just to survive. Under those macro slowdown conditions, our risk mapping indicates the stock price could easily drop back to the $50 to $70 range. That represents a 20 to 40% loss from today's prices. For a new retail investor, jumping into a capital trap before the company proves it can achieve sustained profitability at scale is a very dangerous strategy.
Well, I think we can both agree that Nebius Group possesses a powerful AI infrastructure theme. It's a stock with incredible beta and undeniable high-risk, high-reward characteristics that perfectly encapsulate this current AI hardware supercycle.
Absolutely. The tension between their staggering 830% ARR growth and their daunting capital burn rate really is the defining narrative of the entire neocloud sector right now. There's certainly much more to explore in their upcoming financial materials, and it'll be fascinating to see how they continue to compare to peers like CoreWeave as the year progresses.
We will leave it to the listener to weigh the evidence and decide their own investment strategy. Thank you for joining us on The Debate.